everyone, welcome to the next installment of Charts and Perspective, where we use charts to dive into the world of economics and financial markets. I'm Jennifer Nash, an economic and market research analyst for TMX Verify. There was a lot of market volatility during the first half of the year. We saw a modest gain in January, followed by 3 consecutive months of losses, including March's major decline. Things seemed to turn around in May, though, with the index posting a strong rebound. The momentum continued into Jan, with the S&P gaining nearly 5%. But where does the index line up if we zoom out our timeline to begin over 100 years ago? Today, we're going to answer that by looking at the market's overall valuation using 4 indicators at update time. The 4 market valuation methods are the Crestmont PE ratio, the PE10 ratio, the Q ratio, and the relationship of the S&P 500 to a regression trend. I won't get into the specific methodology for each of these, but they are different and tell us different things. However, one thing they have in common is that these indicators and others help gauge whether the market is over, under, or fairly valued compared to historical norms. By analyzing multiple indicators, we get a broader, less volatile perspective than if we just relied on a single one. To simplify comparisons, I've adjusted the 2 PE ratios and the Q ratio to their arithmetic means and the inflation-adjusted S&P composite to its exponential regression. On the vertical axis, you can see how much each metric deviates from its mean. Now, the question we're looking to answer is the market still overvalued? From this chart, the answer is yes, but how overvalued? To answer that, take a look at the table in the upper left-hand corner, where we can see how far each indicator is from its mean. In June, the Crestmont PE ratio was 155% above, the PE10, 104% above, the Q ratio, 118% above, and the inflation-adjusted S&P composite was 173% above its regression trend line. That puts the market's overvaluation somewhere in the range of 104 to 173%, depending on the indicator. This is the highest level since February and marks the second straight month the overvaluation range has increased. That should come as no surprise, however, when considering the market movement I discussed at the beginning of the video. Now let's take a look at the average of these 4 indicators and plot it, along with standard deviations above and below its mean. At the end of June, the average stood at 137%, over 3 standard deviations above its historical mean, and one of the highest levels in history, signaling an overvalued market. Looking at this chart, you can see the current market valuation based on our average is higher than it was at the peak of the dot-com bubble and is just below the market peak from a few years ago. Now, I want to provide an alternative view. Let's adjust the Crestmont PE, the PE10, and the Q ratio to their geometric means rather than the arithmetic means, the typical average most people think of, that we use in the first 2 charts. With this approach, the overvaluation range shifts higher, now between 125 and 182%. Again, plotting the average of standard deviations, we see the latest figure at 156% is over 3 standard deviations above its historical mean. So let's go back to the initial question. Is the market still overvalued? Each of our charts has led to the same conclusion. The market is significantly overvalued, currently sitting among some of the highest levels on record. Now to wrap up, I want to point out that these indicators are not short-term market timing tools. Overvaluation and undervaluation can last for years, as we see in these charts. Instead, they're more appropriate for formulating expectations for long-term market performance. That's all for our June 2025 market valuation update. Thank you for tuning in. For more economic and market insights, you can find my content regularly on the Advisor Perspectives website under the AP Chart section.